Well, the conversations that I'm having, I think advisors and their clients are thinking about restructuring the entire framework of their portfolios. Because if you think historically, 60/40 worked fine because stocks and bonds were, zero correlated or negatively correlated at periods, and yields were falling. So you had this tailwind supporting both the stock and bond markets. Now looking forward, you have, near zero yields in bonds. Equities are relatively expensive, and inflation is the biggest concern looking forward. So all of those are bad for a 60/40 portfolio. So if you think about what the future, let's say 5 to 10 years looks like, it's a big guess as to if we're going to have high inflation. We could even have deflation if we end up like Japan. All this money printing and zero interest rates. What does it mean? All the political concerns, the debt ceiling talk. There's just so many big forces at play. So the potential outcomes in the future could be wide ranging, and the odds of an extreme outcome is greater. And so being really well diversified is probably the most important thing. That's probably the biggest message I would share today. And 60/40 isn't really that well diversified. It's equity dominated. You have 60% in a volatile asset, 40% in a low volatile asset. And so that portfolio as a whole is going to be over 90% correlated to what the stock market does. You basically have all your eggs in one basket without realizing it. And I think people are starting to become aware of that. And so we think of it in the risk parity framework, where effectively you own assets that do well in different environments. So you protect yourself against all those outcomes, and then you risk balance them so that for the most part, you're indifferent to what the future looks like. And that means owning assets like equities, even treasuries, even with their low yields, because if you get a downturn, it's likely to appreciate.